Let us start with what actually happened, because the sequence matters here. On the 13th of May, Commonwealth Bank released its third quarter capital markets update. On the surface, the numbers were not catastrophic. Unaudited cash net profit after tax came in at $2.7 billion for the quarter, up 4% on the prior corresponding period. Lending grew, deposits grew, capital remained strong, with a CET1 ratio sitting above the sector average at 12.3%. But the market reacted like a fire alarm had gone off. CBA shares fell in what was described as their biggest one-day decline on record. The drop reached 14% at its worst. Why? Two things collided at the same time. The night before the Q3 update, Treasurer Jim Chalmers delivered a federal budget that changed the rules around negative gearing. Under the new policy, negative gearing deductions would only apply to newly built homes. Deductions on existing investment properties would be eliminated. That was a direct shot at one of the key demand drivers behind CBA's mortgage book. If housing investors pull back from existing properties, loan origination slows. And if origination slows into a rate cut cycle where margins are already compressing, the earnings picture gets complicated quickly. Investors did not wait to find out how bad it would be. They sold first and asked questions later. Then, just as quickly, the rebound started. CBA shares climbed back roughly 7% from the post-crash lows. No price-sensitive news was released to justify that most. The most likely explanation is a combination of bargain-hunting retail investors and a rotation into quality names during a volatile period driven by the ongoing Iran conflict in the Middle East. CBA, as Australia's largest and most recognizable bank, has historically attracted a safe haven bid when broader markets wobble. That rebound is exactly what makes this stock so interesting to analyze right now, because the question is not CBA is a good bank. It clearly is. The question is whether a good bank trading at a very high multiple is still a good investment.
Here is the number that is driving the institutional view on CBA right now. Commonwealth Bank is trading at approximately 28 to 29 times forward earnings. The banking sector average in Australia sits around 18 times. NAB is trading at roughly 15 times. ANZ is at around 14 times. That is not a small gap. CBA is priced at roughly 87% to 90% above the peer group on a price-to-earnings basis. For that premium to be justified, CBA would need to permanently outperform its peers on every key metric, every year, into the indefinite future. UBS put it plainly in a recent sell note. The current price is pricing in perpetual outperformance. What does the data actually show on those key metrics? CBA's net interest margin sits at 1.99%, against a sector average of around 1.78%. That is a real edge. CBA earns more per dollar lent than its peers. Its return on equity is 13.1% versus a sector average of about 9.35%. Again, genuinely above average. But here is the issue. Those metrics would support a premium to the peer group. They probably do not support a premium of 87% to 90%. The two most common valuation models used by analysts tell the same story. A sector-adjusted price-to-earnings model, using the peer group multiple of 18 times applied to CBA's earnings per share of $5.63, yields a valuation of roughly $101 to $103. A dividend discount model, using CBA's $4.65 annual dividend, with modest growth assumptions and a standard risk rate, lands fair value in the range of $98 to $101 in cash terms. Adjusted for franking credits, that gross valuation extends to roughly $143. CBA is currently trading near $164 to $165. That is a very large gap between where the models say fair value is and where the stock is actually trading. The consequence of that gap is visible in the consensus data. 14 out of 16 analysts currently have a sell or strong sell rating on CBA. The average analyst price target is $127.57. That implies downside of roughly 22% from current levels. Some analyst targets go as low as $90, which would represent a 45% decline. That is an extraordinary degree of institutional bearishness on Australia's largest bank. And yet the stock has not fallen to those levels. It has bounced back 7% without any positive news catalyst. Something is keeping CBA bid above what analysts believe it is worth.
To understand what is actually happening with CBA, you need to understand that two completely different investor populations are trading this stock simultaneously, and they are operating on entirely different logic. The institutional view is driven by valuation models. At 28 to 29 times earnings, CBA is expensive relative to its own history and expensive relative to peers. The RBA is now cutting rates, which reduces net interest margins over time as mortgage repricing flows through the book. The negative gearing budget change creates uncertainty about future housing credit demand. If earnings do not grow fast enough to justify the current multiple, the multiple must compress. And multiple compression from 28 times to, say, 20 times would imply a price decline of roughly 30%, even if earnings remain flat. That is the institutional thesis. It is a disciplined, model-based argument. The retail view is different. CBA is Australia's bank. It pays fully franked dividends. It has survived every recession, every rate cycle, and every housing downturn in the modern era. When markets get volatile, CBA goes up because it represents stability. The Iran conflict driving Brent crude above $93 a barrel and disrupting travel and energy markets has made investors nervous. In that environment, a large, familiar, dividend-paying bank looks attractive. The result is a stock where institutional analysts are pointing to a $127 average target price, and retail investors are buying every dip back toward $164. Neither side is irrational. The institutional case for mean reversion is supported by decades of valuation theory. The retail case for quality persistence is supported by CBA's actual long-term record. But only one side can be right about what happens next, and the hidden assumption in each camp is worth naming explicitly. The institutional bear case assumes that the retail premium for CBA will eventually evaporate. The assumption is that at some point, the 87% price-to-earnings premium above peers becomes too uncomfortable to hold, and sellers overwhelm buyers. The retail bull case assumes that CBA's franchise quality is so structurally superior to peers that a permanent premium is warranted. The assumption is that CBA's return on equity lead, net interest margin lead, and brand moat are not cyclical advantages, but structural ones. Those two assumptions cannot both be correct in the long run. What is interesting is that both of them are live in the price right now.
There is a narrative circulating in the market that the RBA's rate-cutting cycle is positive for CBA. On the surface, that logic makes sense. Lower rates should stimulate credit demand. More lending means a bigger loan book. A bigger loan book means more revenue for the bank. CBA, as the largest mortgage lender in Australia, with more than 20% market share, should be one of the primary beneficiaries. But the second-order effect runs in the opposite direction. When the RBA cuts the cash rate, the short end of the yield curve moves down faster than the long end. Banks like CBA borrow short and lend long. As short-term funding costs fall, the rate at which new deposits are priced also falls, but existing mortgage rates, particularly fixed-rate loans, do not reprice immediately. The initial effect on net interest margin can therefore be positive. However, as the rate cycle continues and competition for mortgage market share intensifies, banks are forced to pass through more of the cuts to borrowers. The margin between what CBA earns on loans and what it pays on deposits narrows. CBA's net interest margin is currently sitting at 1.99%. That is above the sector average of 1.78%, but it has already been compressing, and the full impact of the RBA's recent cuts has not yet flowed through the earnings guidance that investors are currently pricing. UBS flagged this explicitly in its sell note on CBA. The bank's net interest margin compression from the rate-cutting cycle has not yet fully appeared in forward guidance. That means the earnings number that the current 28 to 29 times forward price-to-earnings multiple is being applied to may itself be too high. If forward earnings come down as net interest margin compresses, the effective multiple is even more stretched than it looks today. Add the negative gearing policy change reducing housing investor demand, and there is a scenario where both the numerator, the price, is elevated, and the denominator, earnings, may be about to shrink. The forward checkpoints investors should be watching are concrete. The full-year FY26 result is approaching, and it will include the first full quarter impact of the rate cuts. Any guidance on expected net interest margin trajectory for FY27 will be closely scrutinized. The RBA's next rate decision is also a live event. For CBA holders who bought during the rebound, the risk is asymmetric in a way the safe haven narrative does not fully capture. If rates fall further and earnings disappoint, the two pillars of the retail bull case, income stability and quality resilience, both come under pressure at the same time. That is the forward scenario no one holding CBA at 164 wants to model, but the institutional analysts who are almost unanimously rating this stock a sell have already modeled it, and their answer is a price somewhere between 90 and 128. The gap between that target range and the current price is the unresolved tension sitting inside every CBA holding right now. When the FY26 result lands, that gap will either start to close or start to confirm which camp was right. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.